Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is December the 27th, 2025. Last week, we explored sovereign debt defaults, how France's two-thirds bankruptcy and Spain's serial failures demonstrated that governments can always choose not to pay. We discovered that broken promises destroy credibility and create vicious cycles that can haunt nations for generations. But here's what makes corporate debt fundamentally different. Corporations can't simply decree their debts are worthless. They face bankruptcy courts, legal consequences, and investors who can seize assets. Today, we're exploring how these constraints shaped corporate bond markets and created the protections that make lending to businesses viable. So, let's picture America back in the 1860s. Railroads need enormous capital to lay thousands of miles of track. As we explored in our Equity Securities series, railroad companies issued stocks for ownership to raise this money, but they also issued bonds, promises to pay fixed interest and return principal on specified future dates. By 1870, American railroads had issued hundreds of millions of dollars in bonds. Farmers, merchants, and other middle-class investors across the country invested their life savings in these promises. The corporate bond market had been born, but it created an immediate problem. Without systematic information, investors couldn't assess risk. Railroad companies issued glossy promotions promising prosperity, but actual financial data was sparse and unreliable. This information asymmetry made corporate bond markets risky and inefficient. Remember Henry Varnum Poor from our Equity Securities series? When we explored how railroads brought stock ownership to the middle class, we discovered how Poor pioneered financial analysis starting in 1849 as editor of the American Railroad Journal. His work proved equally crucial for bond investors. In 1868, Poor launched Poor's Manual of the Railroads of the United States, offering detailed financial data that helped investors distinguish solid railroads from shaky ventures, whether they were buying stocks or purchasing bonds. But as the bond market exploded, individual investors couldn't possibly analyze hundreds of different railroad securities. They needed a simpler system, a shorthand for creditworthiness. So, in 1909, John Moody provided the solution. His company, Moody's Investors Service, began assigning letter grades to railroad bonds based on rigorous financial analysis. The highest quality bonds received AAA ratings, that's AAA. Lower quality bonds received progressively worse grades. So below AAA, you had AA, then single A, then BAA, and then BA, and then just B, and so on and so on. This was revolutionary. Instead of reading hundreds of pages of financial statements, an investor could glance at Moody's rating and immediately understand a bond's relative safety. A BAA bond paid higher interest than a AAA bond because it carried more risk of default. Poor's publications evolved into Standard Statistics, which later merged with Poor's Publishing to form Standard & Poor's, one of today's big three credit rating agencies, alongside Moody's and Fitch. Credit ratings democratized bond investing by making credit risk comprehensible to ordinary investors. They also created accountability. Companies with poor ratings paid higher interest rates, giving them powerful incentives to maintain financial health. Now, ratings alone couldn't protect bondholders. Corporate bonds needed legal infrastructure. The solution was the bond indenture, a detailed contract specifying promises and consequences. Typical indentures included specific payment dates, restrictions on issuing additional debt, limits on how much total debt the company could carry, and what collateral was pledged against the bond. Most importantly, indentures appointed trustees, typically banks, to monitor compliance and act on behalf of all bondholders if problems arose. Individual investors didn't need to police companies themselves. The trustee did it for them. Now, the Trust Indenture Act of 1939 formalized these protections, requiring companies issuing bonds to create proper indentures with qualified trustees. This federal regulation emerged from Depression-era bond defaults that exposed how poorly protected many bondholders had been. Here's where corporate bonds differ most dramatically from stocks and sovereign debt. When a company fails, bankruptcy law establishes a strict hierarchy for who gets paid. Secured creditors, or bondholders whose debt is backed by specific collateral, well, they get paid first. If a railroad pledged its locomotives as collateral, secured bondholders can seize and sell those locomotives to recover at least part of their investment. Unsecured creditors, or bondholders with no specific collateral pledged to them, get paid next, sharing whatever assets remain after secured creditors are satisfied. And finally, common stockholders get whatever's left, which is typically nothing. This is why bonds are generally safer than stocks. Bondholders stand in line ahead of equity investors when companies fail. This hierarchy creates powerful incentives. Companies know that defaulting means losing control to their creditors. Bondholders know they have legal claims senior to that of common stockholders. This structure makes corporate lending viable in ways that sovereign lending, where no legal hierarchy exists, could ever be. Now, today's corporate bond market represents the culmination of these historical developments. Companies issue billions in bonds daily, financing everything from factory construction to technology acquisitions. Credit rating agencies assess creditworthiness using sophisticated financial models. Bond indentures run hundreds of pages in length, specifying detailed protective covenants. Trustees monitor compliance continuously, and bankruptcy courts enforce creditor rights when companies fail. This market has grown enormously. As of 2025, outstanding U.S. corporate bonds exceed $11 trillion, a testament to the successful infrastructure built over 150 years to make corporate borrowing accessible to ordinary investors while profitable enough for sophisticated institutions. Understanding corporate bonds matters because they offer something stocks can't: contractual promises backed by legal protections. Bonds provide income and relative safety, but limited upside. Most successful long-term investors hold both, using bonds for stability while stocks drive portfolio growth. Next week, we'll explore how governments learn to regulate bond markets after devastating crashes revealed the limits of market discipline. Until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your neighbors, your colleagues, and maybe a family member if you like them. The show is produced by Nicholas Temte, and we'll see you next time on Money Lessons.